You're looking at a pair of sneakers online. $200. Your thumb hovers over the checkout button, hesitating, doing the quiet mental math everyone does before a purchase that size. Can I actually afford this right now? Then a small line of text appears beneath the price, or 4 interest-free payments of $50. Something shifts, instantly, almost involuntarily. The $200 number stays on the screen, but your brain stops reacting to it. $50 feels manageable. It barely registers as a real financial decision at all. You tap buy, without ever seeing a credit application, signing a formal loan contract, or speaking to a lender. You are approved. That frictionless tap is the entry point into a rapidly expanding global financial architecture. Buy now, pay later. Using data from the Federal Reserve Bank of Richmond, domestic transaction value has grown roughly 20% per year, reaching an estimated $70 billion. Globally, total volume has surged past $560 billion, utilized by over 380 million shoppers worldwide. This system is a carefully engineered psychological architecture designed to strike at the exact split second consumers are most vulnerable to checkout illusions. This system functions as a vacuum, designed to eliminate the friction of spending at the exact point of sale. To understand why these installment buttons have invaded nearly every digital storefront, we have to follow the money on the other side of the counter to the retailer. Retailers traditionally accepted a 1.5 to 3.5% processing fee. Buy now, pay later fees commonly range from 4 to 6%. On paper, this looks like an awful deal. Why are global brands racing to integrate a system that charges a premium? Modern retail survival is governed by 2 specific metrics: average order value and checkout conversion rate. Merchant data proves that adding a pay in 4 option causes the average order value to surge by 30 to 50%. It slashes cart abandonment at the final, most painful step of the transaction, ensuring the shopper follows through. Paying an extra 3% processing fee is trivial for a corporation if the installment button reliably tricks consumers into adding an extra jacket or premium tier to their cart. Buy now, pay later operates as a merchant-subsidized sales accelerator, where retailers pay premium fees to bypass customer spending discipline. To see how a $200 price tag morphs psychologically into $50 every 2 weeks, we have to map the human neural pathways at checkout. This setup triggers a core behavioral bias known as hyperbolic discounting. Our evolutionary wiring prioritizes immediate rewards while heavily discounting future costs. The brain simply doesn't evaluate $50 today and 3 installments later with the same risk assessment alarm it triggers for a single immediate $200 withdrawal. Checkout interface designers map this biological blind spot down to the exact pixel. This visual layout isolates the trick. The full $200 price is displayed in muted, smaller typography. Directly adjacent to the one-click buy button, the $50 installment badge is rendered in bold, vibrant colors. This intentional design creates frictionless decoupling. The act of buying is severed from the physiological pain of paying. By the time installment 2 or 3 auto-debits from your checking account weeks later, your psychological connection to the purchase has dissolved. The money leaves silently in the dark. The checkout screen is a weaponized environment, mathematically designed to disconnect logic from impulse before you realize a choice was made. The machine works precisely as intended, a merchant model built to inflate shopping carts, paired with neuromarketing tactics that disarm your natural risk assessment. But individual behavioral psychology becomes a systemic trap at scale. Nothing stops a shopper from repeating this exact transaction on a fashion app, then an electronics site, using 3 completely different providers in a single day. Because the system bypasses traditional credit checks, there is 0 unified tracking. These platforms operate as a shadow lending market, with no communication regarding what an individual already owes across the network. The inevitable collision happens when those unmonitored bi-weekly auto-debits hit the same checking account at the same time. These concurrent withdrawals trigger a compounding financial chain reaction known as the overdraft cascade. The system does not make consumer goods more affordable. It hides the true cost until the trap snaps shut, transforming temporary checkout illusions into a systemic debt cycle. The process begins with loan stacking. A consumer takes out multiple buy now, pay later loans simultaneously across different fintech providers, without any single lender having visibility into what the others have already approved. To understand the scope of this behavior, the Consumer Financial Protection Bureau analyzed loan-level data across industry leaders like Affirm, Afterpay, and Klarna. The results showed that 63% of all BNPL borrowers carry simultaneous active loans. Within that group, 32% are actively stacking loans across multiple different platforms at the exact same time. Heavy users originate more than one new loan every month, averaging 6.3 separate loans per lender in a single year. Crucially, 61% of these users hold subprime or deep subprime credit scores, leaving them with the thinnest financial cushion to survive a repayment collision. This behavior flourished because these microloans successfully evaded major nationwide credit bureau reporting for years. A consumer can borrow from Klarna and Affirm back-to-back, leaving traditional mortgage and auto lenders completely blind to the active microdebt. Measured, this phenomenon is known as phantom debt. These are real, legally binding liabilities that exist entirely outside the view of traditional credit monitoring infrastructure. The hidden nature of loan stacking creates a highly fragile financial baseline for the average household. The crisis is triggered by the collision between rigid, biweekly auto-debits and unpredictable household pay schedules. Federal Reserve data confirms that BNPL users experience a higher rate of checking account overdrafts and maintain lower average bank balances than non-users. CFPB findings show these users are also more likely to carry revolving high-interest credit card debt and frequently rely on emergency payday loans. To see the domino effect in real life, consider a shopper carrying 3 separate installment plans. 2 heavy auto-debits hit the account simultaneously, dropping exactly 48 hours before the next payday, running the consumer's checking account completely dry. Rather than declining the charge, the bank processes the payment and hits the consumer with a $35 overdraft fee. A single miscalculated timing gap causes fees to stack. Bank overdraft charges pile on top of provider late fees, which sit on top of the original loan balance. Industry statistics show that 47% of users reported paying late fees recently, a number that climbs to 40% among low-income households. There is a practical bypass. Nearly 90% of borrowers who call for a waiver succeed, yet most of these consumers never actually attempt it. The model operates as a high-friction financial trap, where inescapable timing gaps translate into cascading fees. As phantom debt and overdraft rates proliferated, federal regulators attempted to initiate a major crackdown. In May 2024, the CFPB issued an interpretive rule to legally classify pay-in-4 products as credit cards under the Truth in Lending Act. Subsequent administrative shifts caused this aggressive stance to be withdrawn, leaving federal policy in a state of flux. Oversight currently remains an unsettled patchwork of state-level licensing and disclosure laws. The industry argues that BNPL serves as a cheaper bridge than 25% APR credit cards, provided payments are made on time. Many users maintain healthy credit profiles, using the installment model purely for cash flow convenience, without ever missing a payment. This leaves regulators with a fundamental dilemma: whether to enforce rigid credit card laws, even if the added compliance costs risk destroying a free option for millions who use it safely. Buy now, pay later represents a systemic evolution in how debt is issued and concealed. The platform is a hyper-optimized sales architecture, engineered around human cognitive blind spots and funded by merchants to expand checkout carts. This entire system rests on a shadow debt model that traditional banking infrastructure never anticipated. For anyone with active BNPL plans, the most effective response is to build a unified ledger today. Log into Klarna, Afterpay, Affirm, and pay in a single sheet of paper. Seeing the total combined number in one place instantly breaks the phantom debt illusion. We want to hear from you. What is the highest number of simultaneous BNPL installment plans you have ever juggled? If you noticed any pacing issues or legal details that needed more depth, please call them out in the comments. We read your feedback to make every documentary sharper. Hit like, subscribe for weekly deep dives into consumer finance, and share your thoughts below.